two charts. I'm using ThinkorSwim here, guys. What I have here is gold futures, GC/GC. Do you guys realize that if you do GCZ8, you'll be looking at the December contract? DC18, sorry. You'll be looking at the December contract. If you just put GC, you'll get the rolling contract. So if you want to look at more data, always look at just /GC. That's going to be the rolling contract. That will allow you to look at more historical data in futures. Did you guys realize that? I'm assuming that, I'm going to make the assumption that you do know that. So why am I showing you this? Down here, we're looking at gold relative to oil. All it is, guys, is gold divided by oil. I think it's fair to make the assumption that gold is correlated by or affected by the moves in oil. Oil is affected by the moves in natural gas, is affected by interest rates, by equities, right? It's a global economy. Everything works together. Everything pushes and pulls together. Gold doesn't trade in just isolation, in a vacuum, away from the rest of the economy. Like all of a sudden, if oil goes from 55 to 100 today, that's going to drastically affect every single asset class. It's going to drastically affect every single stock. Even stocks that are not affected by oil, it's still going to be affected. Everything's tied together. We live in a global economy. I look at the relationship of gold relative to oil. This shows their relationship going back to 2015. If you look at their relationship going back, when it gets really high, like it did here, that just means that gold's expensive relative to oil. When it gets down here, that would mean that gold is inexpensive relative to oil. So we use things like this to make educated trading decisions on where we want to risk money. Again, this is just like a basic indicator that I just built, one divided by the other. And when it gets low down here, that might be a good reason to get into a trade looking gold relative to oil. Okay, just want to pull up a chart of oil next to it so you can see how these things kind of move. So GC, we'll look at CL. And so right here, October, it traded down to 14. When it traded down to 14, that was the cheapest that gold has been relative to oil going back to October of 2015. And so you can see how it moved. This would be 10.3, and this would be, right around this area. And then obviously the oil was the big dropper. And as oil plummeted, this ratio came back to its average. Okay, it came back to like a mean reversion type of trade. So if I was going to summarize how I approach the market, I went to the Bears game last night. I didn't get home till like 12:30. I was freezing. I was miserable. I went to the Bears game because I had an invitation, and I felt bad saying no. But I hate sitting out in the cold. Ugh. Okay, does this make sense, guys? Does everyone see that? Can you put a yes in the chat if that makes sense? A no if it does not. I'm just looking gold relative to oil, and all I'm showing you is you can see how they moved. So when it gets down here, gold is very inexpensive relative to oil. Okay, makes sense? The important thing, and this is how I trade. I mean, this is an example of gold oil, but this is how we trade really everything that we look at. But what gets people confused is gold is inexpensive relative to oil. I'm following Jonathan. He sounds like a smart dude. He sounds like a nice fella. So I buy gold, and I didn't really make very much money, but yet other people made a ton of money because it turned out the big winner here was oil, getting short oil. It wasn't getting long gold. But the really big winner is the one who did the relative value trade, because the relative value trade, doing both sides of the trade, this is what I refer to as scalable. This is what I refer to as a trade that once it presents, going back to that sniper view, once it presents, you can start laddering into your trade. And so what I like clients to do, how I look at the market, is I decide once I'm willing to put the trade on, and I decide how much money am I willing to risk on that trade. And then if you're willing to risk $1,000, here's where the game starts. This is how you separate good traders from bad traders. How do you ladder into the trade? How do you manage money? And whether you're still in the trade and you didn't get stopped out when the move happened.